In this lesson, you are going to learn how to reduce the variance of your Monte Carlo simulation like a quant. Now, what do I mean by that? Well, essentially, whenever you want to use Monte Carlo as a method for valuing derivatives and options, essentially what you're doing is you're simulating all these different paths from these underlying distributions, and you're taking samples. Now, the more samples that you take, usually the better estimate you're going to get. But instead of doing that, because it's computationally intensive to then reduce the error and to reduce that standard error, that deviation that you have around your estimate, what we're going to do is we're going to look for something that's very highly correlated with the option product that we're dealing with. In this case, we're going to look at delta-based control variates. Now, we're going to exploit this function, the fact that delta is a perfect correlation with the option price, to be able to actually incorporate that within our Monte Carlo simulation to reduce the variance. What does that mean? Well, we as the user don't have to simulate as many samples to reduce that standard error on our option price. So if you really want to get into the nuts and bolts of financial mathematics and understand how a quant is coming up with some more efficient ways of valuing their products, this video is for you. So stick around. So the first thing, as always, guys, is we're going to import our dependency. So we've got math, numpy, pandas, datetime, scipy, stats, matplotlib, we're going to plot stuff, and then I've just used the pyvollib library where all I'm actually going to use is the delta function. And we're actually going to create our own delta function so we can handle numpy arrays later. So don't worry, all of this is on my website, so just follow the link in the description. So control variates and hedging. So the probability distribution of an option payoff after delta hedging has a smaller standard deviation compared to its portfolio's unhedged counterpart. Now, hopefully that makes sense. That's of course the whole point of delta hedging, to reduce that variance in your P&L. We have shown this in a previous video and the link is in the description. So let's consider the dynamics of a discretely rebalanced delta hedge. What do I mean by discretely? Well, obviously we can't continuously hedge. The market's not open every minute of every day, and also it would be impractical with costs. So what we've got here is we've got this equation, and all it is on the left-hand side, we have the premium, which is just the forward price of the premium. We have this delta hedging component where we're just taking the difference between the deltas calculated between one time step and the next, multiplied by the discounted stock price. And that gives us the amount that we're going to accumulate in our rebalancing. Now, we've got that equal to the option payoff plus this eta term. Now, that eta term is for the hedging error, because we're not calculating the sensitivities exactly, so actually calculating delta, there's going to be some error associated with that, and we're also discretely rebalancing our portfolio. So taking that delta hedging component in the square brackets, we're just going to expand that. So obviously you saw before we had the difference between the deltas calculated at time step 1 and the previous time step. And what we were doing, we were multiplying that stock price that we had, the forward of the stock price. So our expectation based on the risk-free rate given that time of that stock price in the future. So we just expand that brackets, and what we can actually do is aggregate terms with the same deltas. So as you can see here, we get overlapping deltas. So if we aggregate it in terms of delta, what we actually get is we get the stock price at time 1 minus the expectation for the stock price at that t+1. So that's actually very powerful, because now this gives us an extremely easy way in the Monte Carlo simulation to calculate this at each time step. So there is an assumption here that we're assuming that the last term is equal to 0. So what do I mean by that? We get this one term that's just left there, the delta n minus 1. Now this is equivalent to just not buying the final delta amount of the asset and just liquidating the underlying holdings from the previous rebalancing on the portfolio to date. So hopefully that makes sense. That's an all right assumption. So now we've got the forward payoff which is just this initial payoff times by the exponential RT, is equal to the option payoff minus the discrete rebalancing plus this error term. Now, the square brackets is the delta hedge. It's a delta-based martingale. What do I mean by a martingale? I mean the expectation in the future is the point at which we are right now. So the martingale control variate, we know the expectation, and here the control variate 1 is this discrete rebalancing, where it's just the stock price minus the expectation of the stock at time ti. So that's very important. We now have an efficient way to actually calculate this during our Monte Carlo simulation between time steps. So at time ti, we can calculate what the delta is, and then we can just multiply it by this factor that we have, which is the forward difference in the stock price expectation. So we realize the stock price ti plus 1 minus the expectation of what we thought it was, and then take that to the end of the simulation by multiplying by that exponential RT, delta t left. So let's get into a practical example. Why do we care about delta hedging, and what are the benefits of using the control variate? Well, I'm going to take some code that we've used in a previous example, which was actually in our delta hedging video. Now, I'm not going to go through all the calculations and code here. You can look it up on my website, but essentially we just simulated out for 100 time steps I've got in this example from a stock price of 100. I calculate each individual time step for 1,000 simulations, and then I can calculate the delta hedging components, the stock P&L, the adjusted P&L, the option carry, the interest that you actually earn on the adjustments, which is important to calculate. And we're just going to compare that delta hedging component to the option payoff. So what I've got here is I've got the data frames, and I'm just going to plot them out. So hopefully everything's pretty clear on this graph, but we saw for this particular option, the price, the fair value price according to the Black-Scholes option pricing model, this is a European call option, is $10 or $11. And you can see here that the delta-based control variate, when it's 0, it's about the option payoff. So I haven't incorporated that into this delta-based control variate. So what you will notice though is that the option payoff is completely linearly correlated to the delta-based control variate. However, there is large error terms based here. Again, the shift from the one-to-one relationship is just because of the initial premium paid, and that's what we're really trying to calculate, isn't it, at the end of the day? So here with 10 delta discrete hedge rebalances, you can see that we have quite a large error between the delta-based control variate and the option payoff. But as we discretely hedge, we increase the amount of discrete hedging that we do, 50 and then 100 different discrete hedges. Again, this is over a 1-year option period. Well, we can actually get a better, more accurate, lower variance idea of what the option payoff is going to be by using the delta-based control variate. So what does this tell us? More discrete delta hedging absolutely ends on convergence towards the option payoff, and that is basic options pricing theory. Remember that the whole idea is that you have a portfolio that you're replicating and can perfectly replicate in terms of the bank account and the stock. So the delta-based control variate, as you increase that number of delta hedging, and in a perfect Black-Scholes world, that would be infinite rebalancing. The price then converges, the option payoff converges to this delta-based control variate. So what can we actually do? Now that I know that it's a bit of a one-to-one relationship, I can then compare that to other hedging methodologies. So what happens if we had a control variate based off gamma? Now remember, gamma is the sensitivity of delta to the change in the stock price. So the control variate is just a random variable whose expected value we know, which is correlated with the variable we are trying to estimate. In the same way as for CV1, so that delta-based control variate, we can have other equivalent control variates which are equivalent to other hedges. Now, gamma is the second partial derivative of this option price with respect to the underlying. So essentially, it's just the sensitivity of delta in small change, depending on small changes of the underlying. So to have gamma as a control variate in a very similar way, here we can actually have, we can accumulate just like before the gammas at the same time step. So we can estimate gamma at each discrete rebalancing time. We know what the change in the stock price was between one period and our next sampled period. We square that and we minus the expectation of the squared change between the stock prices. So this is very powerful. Again, the expectation I've just written out here, it's a little bit different, and you can get this from the underlying dynamics of the SDE, which of course here is Brownian motion, based on Brownian motion in the Black-Scholes model. So why did I tell you all this? Well, remember the whole goal is to reduce the number of samples that we have to take, because we could have a really high dimensionality problem and we want to reduce computation time. So what's the goal? We want to find control variants that are highly correlated with the payoff of the option, and that's going to lead, as we simulate that together in our Monte Carlo simulation, that's going to lead to a reduced variance in our estimate of the option contract. So here we've got the overarching general formula where we've got the option payoff. So the forward premium is equal to the option payoff minus this sum of beta j, which is just a factor that accounts for the, I've put in quotation marks there, the true linear relationship between the option payoff and the control variates. So the control variates j plus some eta term which accounts for the errors. Again, errors in discrete rebalancing and approximations in the hedge sensitivities. So again, we're approximating delta, we're approximating gamma at each time step, and there's error associated with that. So here, the option price is just the sum of the linear relationships of all those J control variates. So the option payoff here is equal to the forward price of the option, beta 0 we've termed there, plus all the linear, the sums of the linear components of the control variate. So what does that mean? It means that we could add any number of control variates if there is some linear relationship to the option payoff. Now, how do we calculate what the perfect beta value is for each control variate? Well, if we perform M simulations at discrete time intervals, we can regard the payoffs and the control variates as just samples of this linear relationship. So this is just a linear equation, multivariate linear equation, and we've got some noise. So what we can do is we can estimate the true relationship between the control variates and the option payoffs with simple least squares regression. So there are ways to do this throughout the Monte Carlo simulations, and you can add to these matrices with each time step with each simulation. So that's pretty powerful that we can actually determine what the true beta value is actually during the simulation. Now, we don't want a biased estimate of the betas, so one way that we can go about doing this is we can actually pre-compute by least squares regression the relationship that we determine as fair or true between the different control variates and options. Now, we do this first, and then we can use those estimates for beta j, depending on what the control variate is, to price any number of options. So it's almost like you don't want to be calculating your beta variable while you're doing the actual valuation of the contract, because then that's when you get the bias. Whereas if you treat it as an out of sample thing, where you do a whole bunch of simulations on some sample of payoffs and control variates, then you work out the beta relationship, and then out of sample you value a whole bunch of different contracts using that beta value. That's what I recommend. So now that we've gone through the theory, let's get into Python. Implementation of delta-based control variates. So here we've got CV1, just a reminder of what it is. We're going to calculate the delta at each time step. We're going to simulate the next stock price, TI plus 1, and then we're going to minus the expectation of the next stock price. Sorry, that should be TI plus 1. So essentially what that gives us is just the forward expectation, the forward price of the stock price right now. So in that multivariate sum equation that we had before for the general Monte Carlo simulation with control variates, we only have this beta1 term here. Now beta1 is going to be -1. Now that's an appropriate value because we have the exact relation, delta is the exact relationship, a one-to-one relationship for European options. So that's very important. So we know it's a one-to-one relationship. We just saw it in the graph above, but that's really embedded in option theory. Reason that is because when you do the Black-Scholes PDE model and you actually cancel out terms because you make delta equal to this value. So that's very important to remember. So here we've got the initial derivative. Now again, just like the last 3 videos, we're going to be doing this on Commonwealth Bank of Australia. Again, a real option price that it was in the market. And here we've got the stock price, 101.15, strike price, 98.01. Why do strike prices end in 0.1 in Australia? Don't ask me. Volatility, 9.9%. Risk-free rate, 1.5%. Number of time steps, 10. Now again, we could just go 1, but I really want to illustrate how time steps come in here into the below Python code. 1,000 simulations. Market price was $3.86 on January the 17th. So, and again, the time we've got 0.164 years. So let's get into the slow steps. So what are we doing here? We're going to, in contrast to the last couple of episodes, we're actually going to simulate the stock price ST directly because we require that value during the calculation to determine what the delta is. So here, the pre-constants are exactly the same as the last couple of videos. Got n, we've got the time step, so just t divided by n. We've got nu dt, which is just the drift term, so r minus a half volatility squared. So here we've got vol SDT, which is just the diffusion component of this Black-Scholes model, the SDE. So we've got volatility times the square root of dt. Now we've got this new term ERDT. ERDT, it's just the exponential of the risk-free rate and the change in time. So it's just that forward factor that we're going to be multiplying. That's just a variable that makes it easier. We've just got beta1 equals -1. Remember in our basic step through, we've got these standard error placeholders. Now for the Monte Carlo method, we're just going to step through M simulations. So for each simulation, we're just going to initialize the parameters ST as the stock price and CV, the control variate, as 0. Then we're going to step through J time steps within each simulation. We're going to calculate this error term just by taking a sample from the random normal distribution. We've got delta ST. Now this is literally the delta at the particular time step for the option. What does that require? Well, we've imported from the vollib library and it takes the flag, so it's a call. We've got the stock price, the strike, we've got the remaining time, right? The remaining time, we're stepping through by time of this option, and we've got the risk-free rate and the volatility. So here we're actually going to be simulating the next stock price forward. Again, Monte Carlo simulation. So we're taking the initial stock price multiplied by the exponential of the drift term plus the volatility multiplied by that square root of time times by the random factor. So our Brownian motion, which is that epsilon value. So now we've got the control variate, which is a little bit different. We're taking the sum of the control variate over these different time steps, and we're just adding the delta ST, so delta times by the difference between the stock price that we've just simulated and the expectation of what the forward expectation of what the stock price was expected to be. which again is just the forward of the initial stock price. We then update our initial stock price to be our simulated stock price, and we run through time and simulation. Now, at the end of every simulation, what we do is we calculate what was the actual payoff. Well, essentially we have the max of the payoff of 0 plus now this beta term and CV. And what's this doing? This is just helping reduce the overall variance of this CT term. It's not altering the payoff. So that's important to remember. So we take the sums of the CT and the CT squared, and we're doing that so we can calculate the sigma. So now we compute the expectation, and what you can see is that we have $3.81 with a standard error of 0.01. Now what happens if I get rid of this beta term? You can see that this standard error goes up to 0.107. If we bring it back, you can see we've just reduced the variance quite substantially. So now onto the fast vectorized method. Let's get into it. So here, because we're using NumPy arrays, remember we want to make things really quick. We can't use that inbuilt package from vollib. I realized that halfway through the tutorial. So we're going to take this function that I've put here. I think I may have described it somewhere else on the channel or on my website. But yeah, here we have the delta calculation using the SciPy stats module only. It's our only dependency, and NumPy. So we're going to calculate D1 from the Black-Scholes model, and that's just taking in the European option parameters here, and then depending on the type, given the flag, we're going to use that stats norm CDF function to return what the delta is. And this works for any array shape in NumPy. So yeah, please feel free to use this. So now let's go through. We've got those pre-computed constants again, don't need to speak through them, the ERDT, we've got the CV equals 0 and the beta 1 equals -1. Now here's for the crux of it, the Monte Carlo simulation. Again, we're going to simulate ST directly, not through the log of ST like we have done before. Now, Z is equal to the normal, the random normal. We've got this size of the time step and then the number of simulations, so an n by m matrix. Okay, so now delta ST, this is just going to be the changes in this stock price, and this is to the exponential each time step. So we've got the drift term plus the volatility, the square root of the volatility. So just adjusted for time multiplied by these random normals. And again, risk neutral pricing. Remember, Brownian motion, risk neutral measure. So now for the hard part to conceptualize, I'm doing this all in one step. So I'm not stepping through the time periods. I'm doing it all in one step for all the time periods and all the simulations. And that's where the Python code gets a little bit more complicated. We're going to have to use QMprod to do ST directly now. What we're doing with QPod, well, essentially we've got the NumPy exponential of each individual points of this NumPy array. So all these factors are to the exponential, and what I can do with the exponentials, I can just multiply these exponentials together, and then it's sort of like adding, when you multiply exponents, you're just adding this delta DST term to one another along this array. And again, remember, I'm interested in the final time step only. So we take the cumulative prod of these exponentials along axis equals 0, and we multiply by the initial stock price. Now I'm just doing this concatenate function because what I want is to add back the original stock price at the start of my array. I want to do that because then I'm going to calculate the difference. If I only take one time step, like I am, I think, in this simulation, yep, one time step, I want to be able to calculate a difference between the stock prices. So we need to add this concatenate function. So now we're going to be using this delta calc function. Now, essentially what we're doing is we're taking the entire array of all the stock prices in this simulation, except the last row, because we don't care. We're not doing any delta hedging off the last time step. That's when we realize our option profit, hopefully. I'm taking the transpose because then that lines up with the dimensionality with my time vector here. I'm using linspace to go from big T all the way to 0 with n time steps. And that's to account for the time steps as we decrease in time to calculate the correct delta. So now that you add the vol, you add the flag, and then just take the transpose back to get the right dimensionality in terms of the n by m matrix. Okay, so just like for the one-dimensional case where we're only doing this in each time step, what we need to do is we need to get the cumulative sum along the path of all the deltas at a specific time multiplied by the stock price that we've just simulated minus the expectation of that stock price when we were sitting at the initial time. Hopefully that makes sense. The way to do that is we have the stock difference in the array. So the difference is just we're one step ahead in terms of this array in terms of time, then we're one step behind in terms of this array at this time, but we're multiplying by that ERDT factor, which is just that forward factor that we calculated, exponential RT or delta T. So we take the cumulative sum along all those paths and we get the correct control variate. Now to calculate the payoff, we just have CT equals the maximum of the last row of the ST minus K, and we add back the beta 1 of our last row of control variates. Now, what does that mean? It means that we can calculate the sigma, our standard deviation, quite easily, and what you'll notice is that we have just reduced the standard error compared to the 0.1. If we remove that control variate term, you can see the standard error go up. Now, really important to remember that the more times that we actually delta hedge, so if I delta hedge 10 times in this Monte Carlo simulation, then I can reduce my standard error even further. If I take 100 steps, it goes down to 0.003. So that is just a function of increasing the number of discrete rebalances using delta, and that's a better approximation. So remember, it's not only about increasing the number of simulation numbers, M, it's how many discrete rebalances can you do with your control variates, because that will actually aid to getting a more impactful and precise calculation. So here we're going to compare with a delta base without the delta base control variate. So again, we just had the 3.78 in this simulation with 0.11. We're going to visualize how that looks like. And you can see here that in this case, with this simulation, we've completely been able to reduce the variance of our theoretical expectation, and we've got a pretty good estimate in terms of our standard deviation with respect to that market value. In contrast, you can see we've taken this delta variate, same number of simulations, M, but we have a huge standard error in comparison. So just by adding the delta control variate at each time step throughout this process, we've been able to decrease the variance of the calculation. We've made Monte Carlo more efficient. So in the next tutorial, we're actually going to compare all the different ways, the control variates that we can use, and potentially the combinations that we can use to reduce Monte Carlo variance. And again, this is for valuing any option type. But here we're doing the very simple example of a European call option for illustrative purposes. So hopefully you'll stay with us to the next one. Look forward to seeing you then. Until next time, YouTube.